Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how investors are responding as we make our way back to a new normal. And today we're going to discuss what's supporting these markets despite growing bearish sentiment among economists. Phil, it seems as if, particularly with the Nasdaq 100, stocks are not looking at what's happening with the economy. It seems to be completely disconnected.
Yeah, that's certainly the case if we're looking at what a lot of the economists are saying. I mean, just this week we've had the World Bank come out and say that they project the deepest recession in 80 years. We've had the OECD come out and say they expect globally the market to contract 6%, and even more if we have a second wave. And the National Bureau of Economic Research has said we officially went into a recession in February. A lot of other economists, Deutsche Bank is talking about how the market is definitely not recovering in a V shape when we're looking at employment and returning back to work. And on top of that, you've got people like Fauci, Dr. Fauci, saying that the coronavirus nightmare is not over, and it probably won't be until we get a vaccine, which is likely going to get distributed sometime next year. So the market's hitting all-time highs for the Nasdaq and back in positive territory for broader markets briefly yesterday or the day before. Really doesn't seem to jive with what a lot of economists are showing in their forecasts. I think the supporting factors for the market are just the sheer size of the stimulus, though. And when you look at the amount of stimulus that's been put into the system, it's on a scale with world wars rather than previous recessions and even the Great Depression. So that's a big sort of, I guess, tailwind for the stock market and even for the economy, just because there's so much money in the system. And that's, to me, what supports the market being up, despite the fact that the reality that we see 6 or 12 months from now might prove to be a little bit different.
Yeah, Phil, and we can see this on the next chart here, the gross general government debt. These are significant numbers as a percent of GDP. You have to start thinking about defaults and the possibility of that occurring.
Yeah, and you can see every single country is expected to have a higher amount of debt to GDP when we get to 2022. So pretty much every country is going to be affected by coronavirus. They're doing fiscal spending and stimulus. They're going to run deficits. The real question is, who's it going to hurt? And if you look at the top 6 countries there, sure, you've got Japan and the US, which are kind of reserve currencies, and they can set their own interest rates. And, you know, Japan has obviously run a huge debt to GDP percentage for years without affecting their interest rates. But the other countries are what was involved in the Euro sovereign crisis back in 2011. So it depends how strong your economy is and how strong your currency is, whether you can support these kinds of level of debt. And so then you start to think about what the alternatives are. And this is obviously not a problem to solve this year. Coronavirus is a problem to solve this year. But once we get out of coronavirus, a lot of these countries are going to have to make choice between austerity, which didn't work out great in the sovereign crisis for the European countries. Although they got their debt a little under control, they did not get economic growth going. Default, which you mentioned, which is probably more likely for the countries that are more emerging countries, or potentially inflation for some countries. And inflation is an interesting one because it makes the value of your GDP go up in notional terms, which makes paying back the debt that's sort of got to pull to par easier. But at the same time, it also, as we just talked about recently, makes interest rates go up. And so actually the cost of the debt can go up by even more than you're inflating it down. So there's a lot of not good scenarios and a lot of challenges, I think, for economies in the future.
Let's take a look at the services sector here, particularly bars and restaurants. Now, I know why it's important to me, but from an economic perspective, it certainly is important because the amount of people that it employs.
Yeah, it's not just about the food and the drink that we're all craving, or the decent cooking. You can see from this chart, it's showing as you fall down the chart, the reduction in employment that we've seen. And as you go towards the left on the chart, the reduction in actual sales. And so food and drink is that big circle down the bottom left. And the point of it being big is that's how many people it employs. So huge hit to restaurants and bars. It's one of the big factors in the unemployment rate spiking. It's one of the big things that we need to obviously get back to work if we're going to address unemployment and address consumer confidence. And I just think this is a super interesting chart because it does put restaurants and bars in perspective, just how important getting them working again is to the overall employment picture. But obviously, indoor spaces are one of those risky things that we don't particularly want to do quickly, at least until we've worked out how to do it safely, because we can't wear masks while we're eating, and we're going to be talking to each other. So it's probably one of the activities that's going to be the hardest to get restarted.
So if we take a look at our last chart here and we take a look at new cases by region, and you had mentioned this in the opening, the rise of cases, particularly in the United States and emerging markets, is quite concerning, particularly where we have just reopened. Texas is a perfect example. I mean, the cases continue to break new highs each day.
Yeah, but I think what's great about this chart is it shows it's not a second wave like we talked about at the outset. What we're seeing here is just the evolution of coronavirus traveling through the world. So you can see pretty clearly that Europe, the dark blue section, had a spike early on. It's now getting the new caseloads under control. You can see North America kind of came next. And what we've seen now is it's Latin America, that light blue color, and Asia, which is mostly India. Really starting to see a lot of new cases for the first time, not as a second wave. So it's not great news for the world. It's not great news for the supply chain, but at least it's not a second wave for all of the American and European people going back to work and trying to get their economies restarted.
No, it certainly is encouraging. Phil, thanks so much for joining us on Trade Talks.
You're welcome, Jill.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.